Welcome to this Killik Explains finance video. This week, I'm going to look at some jargon. 5 pairs of words that are in common use, splashed all over the media, but actually often cause a bit more confusion than they possibly should. Some sound quite similar, some don't, but they're not interchangeable. Okay, so with really no more ado, financial markets love jargon almost as much as plenty of investors hate it. It can feel like a black box, a closed door, words being used in ways that people don't expect. So basically we need to get behind terms that might look interchangeable but are actually not. And I've got 5 examples. Now there are lots, but I'm going to give you 5 fairly important examples of what I mean. Some of these I cover in more depth in other videos or podcasts, so I'll just keep to the short version here. Okay, number 1, a classic, risk and volatility. Now, right now, that is August 2019, we are seeing quite a bit of stock market volatility, a seesaw between the underlying economic data, which is not fabulous around the world, and the actions of central banks, either just the US or in combination. So lots of volatility around, but how you respond to that is crucial to your chances of making long-term returns. So what do I mean? Well, risk is for me the danger, and not just me, people like Warren Buffett have said the same thing, that over the long term you fail to make a decent increase in your overall purchasing power. You lose money in real inflation adjusted terms. That is risk. Volatility, on the other hand, is the price you pay to get there. So a bank account has almost no volatility, but it gives you virtually no return at the moment, whereas over the long term, past is no guarantee of the future, shares have demonstrated their ability to add purchasing power to your overall wealth, but the price is that short-term volatility. All right? And therefore, what investors need to be able to do is split these 2 terms out, not confuse them, and manage volatility in the context of not running the risk of reduced purchasing power. Now, I'll put up a quick chart. This looks like a bit of a bamboozler, but it's actually not too bad. So what do we got here? We've got a comparison between the FTSE All-Share, that's the one at the top, this sort of green line up here, and cash, or a cash account. And if you imagine right back in the 1970s at the start, one of the worst bear markets we've ever seen, you had a fairly healthy sum. Doesn't really matter, it could have been £100, but £25,000. You start with that, where would you be? Rolling right forward to almost today, if you can see where those lines finish. And the answer is, in purchasing power terms, depending on the exact data you use, the amount will vary, your cash has been eroded. It only buys around £2,000, a tenth or so of what it bought previously. All right? Whereas shares have demonstrated their ability on an inflation-adjusted basis, and that's crucial, to get you to a better purchasing power number. But notice the route is pretty rocky along the way. So if you like, risk is the idea that you might start here and end up down there rather than up here. Volatility, there's not a lot of it on the bottom line, there's quite a bit of it on the top line, so the key is your approach to it, not trying to avoid it. Alpha and beta, or skill and luck. Now, hedge funds in particular love this kind of jargon. This is another important one, number 2. So, a 10-year bull market, as Warren Buffett put it, floats all boats. Most things go up, passive active vehicles, and therefore people can start to get a little bit complacent and think, whoa, look at all the value I'm adding, when actually what they're doing is climbing on to a well-established bandwagon. All right, and it's easy therefore to confuse ability with pure good fortune. Good fortune being the fact that most things are going up, so you'd have to be trying hard to invest in something that wasn't, especially if you took a diversified approach. All right, and this is a good time therefore to review portfolios. When markets start to enter sort of choppier territory, it's a good time to think about your investment choices, because a bull market might have floated all boats, so let's take a closer look at what some of those boats are actually doing when we head into a slightly more volatile period. So rules of thumb, choose the right tool for the right job. I cover this in more detail in another video. So passive product can be great in certain circumstances. I just want to follow the American market, Tim. Great, a tracker will do that. But where you're talking emerging markets, bonds, for example, slightly more esoteric parts of the world, active funds have their place. So a bit of discernment, I think, is important. Or look under the bonnet when you buy any fund. Can you really tell what it's up to? With a portfolio, you can just look at what's in it. With a fund, do we really know what Neil Woodford, for example, was always up to with some of the less liquid parts of his portfolio? And don't overpay for beta. And what I mean by that is, beta is just someone saying, look, I've made you 10%, hang on a minute, the market went up 10%. So what have you added? Alpha would be, let's say, very crudely speaking, when everyone else is making 10, you're making 20. So don't confuse the two. 3, time and timing. Very similar words, different meaning in investing terms. So what do we got here? Thanks to compounding, that is the ability to earn money on money, interest on interest, time in the market is what counts. Staying invested, not panic selling, not bailing out at the wrong time. However, here's a problem. The growth of apps over the last 10 years, that's the ability to just click instructions through a keypad, has coincided with the last bull market over the last 10 years. And that can make people a little bit trigger happy. It can make people think, oh, I'm a bit of a clever day trader. I'm going to flick myself in and out of these passive products, see if I can make an extra turn. And that's dangerous. Don't be tempted to time the top of the market. I'm going to run for cash now. People have got that wrong over the last 3 to 4 to 5 years in quite spectacular form. And also don't think, well, I'll wait and get in at the bottom. That rarely works either. And the reason it doesn't work is because a JP Morgan study has shown if you miss the best investing days, and they often follow the worst, you can really hammer your long-term returns. So I'll make that point. This is how we lose money. We tend to be greedy and fearful at the same time as everyone else. People always say I'm a contrarian. They don't really mean it. They actually do follow the crowd. So we buy high because we wait for everyone else to buy. We sell low because basically we wait until everyone else has dumped their stock before getting out. That's not good, by the way. And we trade too often in the process because our apps allow us to just buy, sell, in the pub, buy some more. Okay, it can be a bit of a nightmare. And that's the timing point. It's a big JP Morgan study. You can seriously do damage to your long-term returns by getting your timing wrong. If you'd missed the best 10 investing days, 1993 to 2013, you'd have halved your analysed returns from the American market as defined by the S&P 500. Number 4, price and value. This is a classic and people confuse this, not just in investing. So what are we doing here? Price is what you pay for an asset or a meal or a house or some shares. Value is whether you get it for a good price. And there's a key difference between the two. All right? People confuse low prices with cheap and high prices with expensive. Value for money is not about the price. It's about what you're getting for that price. And finally, economies and markets. And this is a classic. The economy and the stock market. Should they move in the same direction? Do they? And are you wise to look at one as a gauge of the other? Well, over the long term, the economy and the stock market will tend to follow broadly the same path. But in the short term, markets in particular react to a whole raft of short-term data, news, sentiment, and so on. All right? They are fidgety, they're jittery in a way that the underlying economy tends not to be in the same way. So don't rely on snapshots from the media of economic data to tell you what's going to happen to the stock market, because the stock market might be in a mood to do the opposite, or it might have priced in something looking forward that isn't reflected, or it might be doing something that you weren't anticipating because of forces out there that actually you haven't thought about. And if I could liken it to the walker and the dog, and I've borrowed this from Josh Brown, the reform broker, the way he puts it is quite neat. He says, if you imagine a man walking a dog across Central Park, let's say, so there's the man, and forgive my drawing, that, believe it or not, is meant to be a dog. It's why I don't do too much freelance drawing. All right, the man will just, broadly speaking, he's the economy, he'll take a path, something like that. You can see the gate, the other end, you might stop and look at a few things. The dog, especially off the leash, will eventually get to the same gate, but the path that the dog takes will look more like that, because that's what dogs do. All right? And the point being, eventually they end up in the same place, but to get there, they take rather different paths. And therefore, looking at the path being taken by the man to predict the path that will be taken by the dog, if I put it that way, probably finish this metaphor there, is potentially dangerous. To find out more, lots of jargon covered there, editor@killik.com. And if you want to watch some of those videos I mentioned that take some of those ideas into more depth, then it's killik.com/learn, and you'll see on the left there's a load of tabs, investing, principles, and the shares tabs. Be good places to start.